All right, everyone, welcome to another episode of Line Your Own Pockets. In this one, we're going to talk about our column library today and some ways that you can make additions to it, a way that I kind of discovered a new indicator that I want to make additions to it. And we're going to give some columns that we think potentially people could look at. And these are ways to help filter and optimize what you're doing currently to hopefully make a strategy just a little bit better. So how are you doing today, Dave?
I'm doing great. Yeah, this is good. I love this topic because even more than strategies themselves, the column library is, if there's any secret sauce, this is it. And
Mm-hmm.
just to go over what the column library is and why I call it that, I'm a software developer. I've been developing software for a long time. And in software development, the way to scale yourself is to create libraries. So you got a bunch of different software projects that you might be working on. When you first start developing, you do what the common thing, which is copy and paste some of the common things, common functions that are used throughout the different projects.
Mm-hmm.
But you quickly realize that when you find a bug, all of a sudden you have to make changes in all of those different projects. The thing to do there is create a library that's shared amongst all the projects. So then if there's a bug, you change it in one place, all your projects update automatically. It's just a way to leverage what you're doing, what you're coding, and it just makes you a lot better. And it helps you think about it helps you think in like more strategically about your code. What sort of functions would make sense to leverage it and have it work across all projects. And so with the column library, it's the same thing, but for trading strategies.
Yeah, that's what I wanted to bring it back to. So what we're talking about is that if you have indicators, or call them whatever you want, right? Indicators or candlestick setups or whatever, and you're telling your backtester to record that on entry. So what is the value of the MACD, or how far are you from the 200-day moving average or whatever? And as soon as you record all of these data points from the moment that you would have entered the trade, now you have this kind of big, robust data set that you can go back and you can say, start asking questions of the data and, hey, is it better if this thing's occurring or that thing's occurring? And we do have, a whole episode about this, so you can go back and look, and we will remember to put it in the show notes here so you guys can go take a look at it. But today we want to talk about kind of adding to that, right? So this is something that I've picked up from Dave, and I went through and I did the work and I put everything that I thought I would need in there. But I think just like having a process for increasing and getting new strategies and adding those new strategies to your trading, it's just as important as having a process to add or to try to open yourself up to new indicators or columns that you could add into this library for kind of what we're going to talk about, which is, the ability to expand out what you're doing quite a bit.
Yeah, and every time you add a new column to your library, just think of the power it has. I mean, you can, when you find something that's predictive in one strategy, the
Mm-hmm.
first thing you should do is go back and add that column to all your strategies that you created before that. Oftentimes you'll find it's predictive there also. And when you find that, that's just extremely powerful because you can go back and improve that strategy. You could, in a lot of different ways, you could use it to exclude the worst trades, but really the more powerful way to do it is you could start with a different starting point potentially and start with something that has more trades with more average profit per trade and optimize from there. So you end up with something that is just more profitable. So it's never ending process, and you're constantly improving your column library, and it just gets more and more and more powerful over time.
Yeah, so where we're starting from this is that, one really nerdy thing that I do is the CMT every year puts out the Charles Dow Award, right? It's just an award that they run, anyone can apply for it. And the idea is that people are coming up with new trading or investing concepts or indicators or relationships or whatever it is. They write papers about them, they submit them, and they pick one. And one of them was a way to kind of normalize the MACD. And this is what spurred on this episode, is because right now putting like an absolute value of the MACD. For those who don't know, it's moving average, convergence, divergence. You can Google it, and there's a whole bunch of resources there. But right now, it's kind of useless for this because the way it's set up, it doesn't compare across securities or through time, right? You take two securities, they're going to have completely separate values, and they're pretty much irrelevant for it. It's one of those indicators that's useful only as a visual tool for people who believe in it kind of only. But this one article that this person did where he calls it the MACDV and it's just a normalized version of it, all of a sudden he normalized it for ATR. So he just made it so that across time and across securities, all of the values are normalized. And then that kind of got me thinking, okay, well, now that this very old school, like built in like the 60s or traditional indicator is now been changed just a little bit, well, now it's interesting for a column library because it has that comparable aspect. And just by doing some nerd stuff and reading these kind of papers from time to time, that light bulb moment went off, and then you go back to work, and then you got to, like we talked about, put it into the column or put it into the library and just start testing strategies that you currently already have in this kind of new light that you wouldn't have seen unless you put yourself in a place to expose yourself to an opportunity of, oh, this is a new way to look at something that's actually quite old.
Yeah, I love that idea of normalizing the data. You're going to end up with something that's way more useful across your strategies and across different securities. I think it's a great idea. So it reminds me of one of the columns that I added that is useful. Like sometimes you don't even realize that something's not normalized. Like for example, a percent gap, like today's gap in a stock. That seems like, okay, that's pretty normalized. But after you think about it for a bit, you could actually use the gap in terms of ATR, which is a way more
Way better.
accurate and more normalized thing. So something you think might be normalized, once you mull over it and think about it some more, you realize, oh, actually, it could be even more normalized. So I really love that.
Well, and I think that's a perfect example. We can hit on that a little bit. Like a lot of people, yeah, they just look at it and they say, okay, well, I want to look at the biggest percent gainers or the biggest, percent gappers or something like that. And that's just standard. You poll like 20 traders and they'll all say the same thing. But the example I always use to talk about why you need to normalize data is a $1 stock that gaps 10%, 10 cents, right? It could be a big deal. It could just be a misprint. It could be any number of things. If Apple ever gaps up or down 10% in a day, they're writing about it in the papers and, it's all over the news. And because Apple's a multi-$100 stock and it's much kind of slower. So that's why I like you take these things and you normalize them where you say, okay, how much does this stock kind of normally move in a day? Well, if it's gapped way more than it normally moves, well, that's something that's potentially interesting. And you can go and just by looking at you're essentially comparing the stock to itself as opposed to comparing the stock to something that's a little bit more arbitrary. And you could do the same thing as, oh, I want stocks that gap up $1. It's like, again, on that dollar stock, that's a big deal. It's 100% gap. On Apple, that's a normal day. Comparing each stock, and I think this is where a lot of traders start to gravitate to things like futures and things like that because it helps them. They don't have to worry about this process because they're looking at the same thing every day, but they miss a lot of edge and opportunity because
Wow,
they
yeah.
can't normalize these things.
That's a great point, Michael. You don't even really have to normalize if you're just looking at futures. So that's I've never really thought about that. That's totally true. Somebody's coming from futures, they're not used to having to do this. Like, why would they be? So
Well,
that's so
and
interesting.
it's funny, you hear from old school and discretionary traders and they say things like, each stock has like its own personality. And you'll hear things like that. And it's not untrue, but what they're just saying is that some stocks are more volatile, some stocks are less volatile, right? Some stocks, probably more in the news, so they gap more and whatever. And this is why you'll even see individual traders float towards, you'll hear the guy say, oh, I trade Apple and Nvidia, and that, he's got like 5 things that he likes to trade. And I would say it's not that he cares about the stocks at all. He's just coincidentally found stocks that fit like an ATR universe and have fit like an average volume and liquidity universe that he likes. And yeah, I think that's a huge reason why people trade things like futures, is because if I'm looking at this one thing every day, it's not that I learn how it, or I feel the personality or the vibes of whatever the instrument is. It's just that I just know roughly how much it moves based off of how much it normally moves.
Yeah, totally true. All right, so I'm guessing that there's listeners now who, in the back of their mind, they have this question. So I'm going to be the devil's advocate to you and let you
Sure.
knock this out of the park. You ready?
All right. Make it easy on me.
All
The
right,
kids
so
aren't sleeping.
Michael, I know that all these indicators are kind of bullcrap, right? Like I know that you're supposed to have as few indicators as possible on the chart. I know the beginning traders add a whole bunch of indicators. They're all worthless. You're talking about adding these to backtest. If they're worthless on the chart, why in the world, like why are you even thinking about this? Why are they valuable at all?
The one that always gets me is they always say, well, indicators, they're useless because they're lagging. And I actually saw my buddy JC, who's the CEO of All Star Charts. He actually answered this on stage in front of like 50 people. And it was about technical analysis or indicator and technical analysis. And all it said, these are all crap because they're all just lagging based off price. And he just looked the guy dead in the eyes like, listen, if you have any future information, you let me know. He's like, everything we're doing is based off past information. I hear that argument all the time. It's like, oh, you should just use price action and not indicators. And I think the simplest answer to that is that indicators are just ways to approximate price action. And there are ways to be able to crunch large amounts of data in price action. Someone says, oh, I only buy stocks in uptrends. Great. What do you mean? Like, what is that specifically that criteria? And without having to go and talk about higher highs and higher lows on a chart or anything like that, it's much simpler to say, okay, above a moving average, right? Because it's mathematically, if it's above a moving average, it's been moving up for some period of time. So, is there one indicator that's amazing and you buy Lambos and yachts with it? It's absolutely not. But these are tools in a tool belt, and they approximate certain things in price action. So it's important that you A, use them, and B, you understand what they're telling you, right? And that's where I think people fall apart, is they're looking for the magic, this line crosses this line and I make
Right.
$1 million.
Yeah, well, even price is lagging, right?
Hmm.
Even in real time, as soon as a price happens, that's by definition, it's in the past. All right, so
Well,
I've
let's hit on that. That's not only, so that's just us technical guys. Imagine the fundamental dudes that are they're caring about last quarter's earnings. So a
yeah.
company will come out and say, this is what we made 3 months ago. Here you go. You want to talk about lagging, or like, here is the unemployment numbers that occurred 6 months ago that's going to get revised 7 times between now and then. Yeah, it goes back to that quote from JC. Is like, if you got any future data, let me know. But everything we're doing is relying on the past. We're just looking for things that tell us certain things about the data that we can play with. So if you're gonna harp on technical people, I don't ever want to see you quote anything about fundamental analysis ever.
So true. Yeah. So you want to tackle this MACDV, you want to put that in your column library.
Hmm.
What's the plan? How are you going to do that?
Well, the beauty of the way I discovered a lot of these, or the way I'm doing these with the Charles Dow Award, because I'm on like a bit of personal mission where they've been doing this for like 50 years. I'm gonna read them all eventually. Mostly, I skim them. I put them into a shout out notebook LLM. I don't know if you've tried this one, Dave, but you can put anything into this and it turns it into a podcast like you're listening to right now with a guy and a girl just talking about it. And I do this all the time with stuff that I would fall asleep reading. I skim it myself as quickly as I can. You upload the paper to this, and then I take the dogs out in the woods and I just listen to this completely made up. Definitely can tell it's AI, no personality, no soul behind it at all. But they're explaining all of the aspects of this. And because it's open, because he's explaining what he's doing, it's very easy to go into a real test or an Amity broker or whatever and just code up the differences to these indicators, and then I can add them to the column library and then start my tests after that.
So do you have a sense of this from the strategies you're trading now and that you've back tested? Do you have a sense of where this one is likely to be valuable or where it's going to have an impact?
Yeah, I'm going to look at all of them, but just from, reading the paper and then listening to it, I can very easily understand what the indicator is trying to do. So it's like we're talking about with the price approximation. This one is now normalized, so it can do things like mean reversion and overbought and oversold. And I have some mean reversion strategies that are using similar indicators currently. So there's kind of two jobs I want to do. One is I just want to replace the indicator I'm using with this new one and just test. In theory, it should be similar, maybe a little better, maybe a little worse. But like you talked about, if it brings in more trades and it's somewhat similar results, then that's good. And then, yeah, put it into the library to use in the cruncher or some of the own kind of analytics that I do myself.
Yeah, so you'll run it through the cruncher, and some of them I'm assuming MACD is sort of important, so you can go back and look and just get an apples to apples comparison. You could see which
Mhm.
one you can see literally if it improves it and by how much, just by looking at the report in the cruncher, right?
Well, yeah, and then whether or not it shows up at all. So what I'll be
Yeah,
interested to see is, maybe because I wasn't able to put MACD in before, but I was putting relationships with two moving averages because it's more relevant. If that never showed up when I run my tests, and then I put this new one in and it shows up, then that's information of itself because it means, the MACD, which is inherently a trend following indicator, a measure of strength of a trend. I can take a look at that and say, okay, well, this measure of strength that I tried to approximate before didn't work, but now it's in here. And like we talk about with everything, that opens up a whole bunch of doors to
yeah,
why, right? And then what else potentially could I build in to confirm whether or not this trend is important or not?
yeah. So the traders that use MabeKit and the Strategy Cruncher, it's kind of a typical path. So when they start using it, they'll, run a back test. They've got all the columns that are included in MakeKit, and they run it, they put it through the cruncher, and all of a sudden they see 10 ways that they never would have thought about of ways to improve their strategy. Maybe they lop off 20% of the trades to really, and then the remaining 80% of the trades are just way better than the entire set. So that's how the typical improvement, but really the most powerful way to get use out of it is strategy 2, 3, or 4 based on what you've learned there by what it's told you. Because now all
Hmm.
of a sudden you can say, okay, I know that this improved the strategy. So let me step back, think of another idea that where I can use this and start from a completely different starting point that has more trades in it. And you that's the real power is you find these relationships in the data, and then you can find a second or third strategy that is just significantly better with more trades than your original strategy. It's a pretty common path and it's I love seeing this because that's exactly what happened to me. 10 or 15 years ago when I created these tools for myself. It's just it kind of blew my mind then, and so it's really exciting to see when people go through the same steps that I was going through.
Well, and what's interesting, I think, is it's just going to sound like really cheesy and motivational or whatever, is that it's not that it so much always answers the question, but it actually gives you more questions. And that's what I found that's interesting about, the cruncher, but also just the column library in general, however you want to do your analysis on it, is that you see that, okay, five things are all kind of trend following. And you go, okay, well, that's interesting. I didn't think the trend would have affected this strategy. Not, doesn't mean you just necessarily plug something in and away you go, but now it's giving you a question of why. And I find sometimes the most illuminating things with the crunchers is when they're not at all what I expected. For example, so we talked about this with an enemy broker. One of the strategies I'm currently building is just a opening range break. I'm just a second day play. The SMB guys talk about this all the time. Is day one you have a huge gap up and a whole bunch of noise. I'm getting kind of old, so the strategy I want to is going to avoid some of that, and then it's looking for day 2 and 3 breakdown, right? So all of the degens have forgotten about this, and they're on to the next crazy, Discord room pumped whatever, and I'm shorting it when everyone else has kind of forgotten about it. And I expected, okay, the more volatile it was on day one, maybe that kind of has some effect, or the more relative volume or something like that. And if I run that and I have these assumptions in my head and they're completely wrong, To me, that's way more interesting when it says, no, 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 you actually want like no volume today, not a lot of volume. You want nothing. And then it makes me think. So for this particular strategy, it makes sense. It's like if everyone's forgotten about it, the volume should just dry out of them and I'm going to be trading these more liquid securities. But just the fact that when I brought it in there, I had assumption A and it told me the exact opposite of that. That's really interesting because then it's just like, okay, now it's time to go back out in the woods and think about it for a little bit with the dogs.
Yeah. And it can be humbling, right? Because you think you know these things. You think your
Hmm.
intuition and experience in the markets have taught you these things that and then when you're confronted with the fact that you might be wrong, like, wow, okay. So I have been humbled so many times with data like that that it's
Hmm.
just too many to count. But yeah, I mean, that's how you grow and that's how you learn and that's how you sort of noodle with your ideas to figure out, okay, how can I use what I've just learned here? And if you just learned something, then it's not, it's probably not commonly known in the trader community. And because of that, you can use that to find some edge.
Yeah, and it's the same thing as, we talk about the building a trader group or a trader community as well. I kind of equate it to someone who just challenges your beliefs. You say, okay, I'm going to take this trade because this thing happens. And discretionary traders do it all the time. And if you have a group that is constantly, trying to crap on your idea, and the whole point is that you want that because if it can withstand all of that, then it's probably a pretty good idea. And if it can't, it probably sucks. And the ability to have kind of a machine do that, because it doesn't know what your idea is. It doesn't, right? You're just giving it raw data. It has no idea what it is that you're trying to accomplish with the trade. And it's just spitting back out some data and you can go, okay, well, this is either good or bad. And yeah, I just find, just like anything, if I had someone who was trading with me and every time I said, oh, I'm going to look to buy this stock, if you're discretionary, he said, oh yeah, it looks great. If that's
Yeah.
the feedback every time, that's a bit useless, right?
Yeah. Like ChatGPT being so
Yeah,
complimentary every time you ask a question. Yeah.
yeah, it's like,
So,
oh,
so it's
whatever.
funny. So, I'm one of the guys I'm coaching now. He said to me the other day, "Thank you for bursting my bubble." Like
Mm,
he had just asked me this question. I think his hopes were really up. Like he saw something in the cruncher, and he was like, "Man, this looks really good. What do you think, Dave?" So I looked at it, and I could recognize I've had this exact same feeling before. I saw the same relationship, and I
hmm.
was like, actually, this is sort of illusory and you should move on to something else. Here's why. So I'm going to explain that to him. And his, I burst his bubble a bit, because you got such high hopes for,
Yes.
and it's really, when you have high hopes like that, and then somebody says, well, actually, it's not right. Like, you shouldn't take that approach. It can be a little bit demoralizing, but you want to learn that way earlier in the process.
Hmm.
You want to be confronted with that early. I mean, the worst time to be confronted with that is to have the market confront you with that and when you're trading money and you realize, okay, I'm losing here, wonder why. And it takes you half a day of digging through log files and comparing backtests to figure out that, oh, okay, well, this isn't quite what I thought it was. That's the worst time to have it. So the earlier in your process you could be confronted with that and find out that your idea wasn't quite as great as you thought it was is always a good thing.
Well, it's good. And I think we've all done that early in the career. So I think it's good to do it. One of those things earlier rather than later is, you're looking to, I think we've all done it where we run a back test and the back test looks amazing. It's like just
Yeah.
straight up and to the left. There's no pullbacks. There's no nothing. You go, okay, well, I've figured out. I hacked the market.
Yeah. Yeah.
Good for me. And
Yep.
then you start trading and you go, okay, there's a slippage thing or, it's getting filled at a weird time or whatever it is. It's just glad that I've learned that early enough that,
Yeah.
and it's the same, this is, I think the importance of bringing in these new columns is that you're always in a state where you don't know what you don't know, right? You don't know that if you only had two or three things that you looked at for every trade, for example, like I know, the common one is it above or below a 200 period moving average or something simple like that. Well, if you're not bringing in columns that make sense, but maybe you don't think they have any effect at all, then you don't know what you're missing is I think the biggest point I'm trying to make is that the way I'm doing is I'm looking at these things and I'm saying, well, I don't, this was a very interesting write up about this new MACD and MACDV. I don't know. Like I'm going to put it into the cruncher and I just may never see it. And that's the important of, ranking these things. But it's one of those, if you don't have a process and a plan to exposing yourself to new filter ideas, you just really never will. And whether it's kind of the way that I'm doing it, where I'm just absorbing content, or someone else observing the market, or however you plan on doing it, it's super important that you're just letting in the fresh thing, because it's, I think, even more important than doing a new strategy, because I can go back and it could do nothing. I could rerun, I could retest all these strategies and have absolutely no benefit whatsoever. And that's okay. I just wasted a bunch of time. You don't know till you get in there. Or it could make some or all of my strategies significantly better just with this one thing, this one paper that I read and then I listened to out in the middle of the woods.
Well, even when a column that you think of and you think might have some effect, and then you go and put it through the cruncher and it doesn't show up in the list, even that's valuable because you had this idea, you had sort of high hopes for it. Now you can move on. You can put that, that that's not valuable, at least for this strategy, but it's in your library for other ideas in the future. It might be important. So you've got this process, and even if it didn't pan out, that's still valuable information even right then, not to mention the fact that you're going to potentially use this in the future anyway. So I want to go back to something you mentioned, which I think was really good, where, and I know a lot of people, a lot of traders think this way, is how does this strategy work when price is above the 50-day moving average or below some moving average?
Mm-hmm.
A very common thing people want to do is add a column that's either a 1 or a 0. Is it above the 50-day moving average or is it below?
Mm-hmm.
And you can do that, but a way more valuable thing to do is to reduce that, or make a column that says distance from the 50-day moving average. It's every bit as good as the 1 or a 0 and way better, because when you reduce something to a 1 or a 0, this binary thing, if it's just barely above, that's 1. But if it's like way, way, way above, that's still a 1 if you're reducing it to a binary. Where if you have this continuous variable that's like distance from 50-day, it's just way more precise. You're allowing the cruncher or whatever tool you're using to regress across that entire continuous variable. And there's just a lot more information there that you're losing that precision on if you reduce it to a 1 or a 0.
Yeah, I think that's important too. We talked about before is you need to know what these indicators mean, and you need to know kind of roughly how they're calculated, because, and it's funny because they make you do this in the CMT, and then I did that 5 years ago. Then I come to this stuff and I just forgot it all, so I had to relearn. But it's important because in some aspects, the indicator just does it on its own. For example, I don't care what the absolute value of the 200 period moving average is. I don't care because it's just going to be a price. It's a useless thing to me. But a RSI, for example, the absolute value of an RSI, that's important. So there's some of them that you should compare price to, and there's some that you should leave as the indicator is itself, and all kinds of things in between. But you're right. I don't want to, for your example, above or below a moving average, you could look at that and saying, well, why would I just set up is the RSI oversold, which generally speaking is under 30. If I just set that up as a binary option, like you said, it would do something. But instead, if I just put the absolute value in there and then I see it pop up as under 30, then I know it's great. But yeah, as soon as you do a binary option, well, what if it's 31? Like, do I just ignore the trade entirely? Does not, and only the data will tell me that, where it's this 30 area that they made for oversold is just an imaginary line that someone put in and said, oh, they usually bounce when they're under this thing. So you got to keep that value on there, right?
Yeah, it's better to take like a naive approach and let it tell you what oversold is. That's really
Hmm.
what you're doing. If you remove the assumption, then you can let the data just tell you what the optimal value is. I mean, that's a way better approach. All right, so let me go over. So there's a couple more here that I have added over the years and were sort of light bulb moments for me.
Okay.
One is position and range. So instead of like above yesterday's high or below yesterday's low, position in yesterday's range is like the same sort of concept, but it can be applied not only to yesterday's range, but all sorts of different situations. And when you watch your trades come through, you're going to develop theories about how things work or how, when things are better, when trades work out better in certain situations. And really, probably one of the best ways to brainstorm for new columns like this is when you feel like you want to override the system, like you feel like you want to exit early because of why, then like figure out what the why is and how you can reduce that or come up with a column for that, add it to your backtest and test your theory. That's a great way to do it. And that's how you improve and get better over time.
Well, yeah, and just to explain and define the position in range, if you just visualize yesterday's candle, and then 100 would be the top end of the range, right? 0 would be the low end, and 50 in the middle, and then you could go right above 100 and below 0. And just like we talked about with this MACD that spurred it on, is that's normalized because you're not saying. Some people might say, oh, if I'm going to do a mean revision thing, maybe I want to short stocks that are really oversold and they're getting up to yesterday's range. That's the idea. Well, you think about programming that in, you could do something like plus or minus like 10 cents or something. But that doesn't, right? That doesn't make sense because on some stocks, that'd be the whole range on some stocks. So this was just a way of saying, okay, well, maybe it's 80% to 120%. And I'm going to use that band of yesterday's high as my area to short. Well, that makes more sense because you can apply that across instruments and you can apply it throughout time and you can kind of build models and systems like that. And that's one of those things that, yeah, I immediately added that to mine as well because it's it is the simplest way to approximize, price action and things like that.
Yeah. So another approach that I've taken, which it didn't dawn on me at the beginning, which it should have. So like when I was mentioning earlier, distance from the moving average or something, like whatever that is, you could use that for all sorts of different things. But what is that distance? What should that distance be? Like you should make it just like we were saying before, gap percentage versus gap in terms of ATR. It's the same thing. Use ATR for those distance columns, and it's like automatically normalized.
ATR your most used like indicator across everything for because for me it's 100%. Like everything I do is normalized. And again, if you want to read the paper, it was the 2025 Charles Dow or 2024 Charles Dow Award winner. But that's what he did is he took the normal MACD and he divided by ATR, right? So it's just one of those things that it's hilarious to see the simplicity of it. However, no one's really done it and kind of published anything about it for like 40 years. But yeah, I just wonder because yeah, for me, ATR, I use it so much across everything. I think it's like a quant's best friend.
Yeah, I'm sure it's used across most of mine, or it contributes to a lot of them. So yeah, I think that's totally true. All right, so here's another one that dawned on me after the ATR. So there's some strategies I have where the stop distance is not determined by ATR. So the distance to the stop, if you're calculating in terms of R and use expectancy for your performance, which you should know about, look that up if you're not familiar with that. You can do a lot of these measurements for that specific strategy in terms of R. So distance to the stop, which may or may not be correlated to ATR, may be exactly ATR for some strategies, but this particular one did not include ATR in that calculation. So now distance in terms of R to different things was highly I mean, very predictive for this particular strategy. So that's another way to, and that one's pretty perhaps signal specific or system specific, but there are probably some ways you could use to apply that across different systems that you have. But it's a really good one that was predictive in a lot of different ways.
So yeah, so what you're saying is, say you're shorting a stop and you're putting the stop at the high of the day, or just for example, you're taking whatever that distance is as the risk value, and then you're feeding that back into a way to normalize a lot of these things and saying, okay, whatever this risk is, I want to use that as kind of a threshold for a way to normalize across this, because in some trades, for that example, you might be risking 1%, and some might be 10%, and some might be 50%. And by doing that distance, it's interesting, and that kind of makes me think of, I do a lot with today's range as well. Right, so you're looking at ATR, which is just a moving average of the normal range. But sometimes you want to take that moving average out entirely. And you want to say, okay, today the stock's moved a buck, and I want to then normalize everything to that. And you could use, I guess, a 1 period RS or ATR for that. But I want to just look at specifically today's action and then start to normalize all my indicator for that particular action for today.
Yeah, I think that's great. I've got one more concept here that I think people will get a lot from. So all that we've talked about so far are what I call entry columns, like columns that you can know about at the time of entry, and therefore you could create a rule based on. These columns, at least the way in AmaBroker, these are calculated and collected, they're actually assigned to the trade at exit time. So you keep track of them at entry time, but they actually get assigned to the trade at the exit. So it's not looking into the future. You're still adding the values that you could have known about at the entry, but they're assigned at the exit. What that allows you to do is you could add some intra-trade columns based on things that have happened since the entry. Now, you can't, of course, optimize on these for the purposes of like making an entry, but what you can do is run one. It allows you to create one back test and test perhaps 3, 4, 5, many different exits. So you could have a column for, all right, what was the profit at noon? You could have another one for, okay, what was the profit at 2:00 p.m.? What was the profit at just before the close? Then instead of having to run like 4 or 5 different back tests just to give you this one answer, like when's the best time to exit? You've got one back test, and you can just look at each of these columns and see, okay, how do they compare? And you can see just from a single back test, you can get your answer.
That's why I like doing this podcast. I never thought of that. That makes perfect sense, because I always, immediately thought of forward-looking things are faux pas, and you want to avoid them at all costs. But right, if you think about it, right, it's 100% right. That's a way to save a lot of time. All right, well, we got one of the. I hope that this is what the audience goes through every now and then, right? They hear something, us rambling on about something, like, oh yeah, that's something, but now I have homework, right? I'm actually writing this down. You guys may have saw me pull out the Apple Pencil, because I've always got this thing sitting here I'm writing on. I'm going to add that into, because some of the, like you guys know, I'm going through this AmaBroker journey with this opening range breakout, and that was going to be one of the questions, right? I've noticed for the stuff that I'm doing anyway, profit targets I don't want to use them, right? I want to let the thing go till the end of the day, because I'm okay with a lower win rate, because what I notice every now and then, you just blow one out of the water. And because, this is, in addition, is the way I'm looking at this trading for me to other stuff that I do, and I don't need the smoothest equity curve in the world. I'm okay with sacrificing smoothness for a potential overall profit. It's the simplest way to put it. But that was going to be the next question. And my plan was literally to run 4 back tests, one entering at the close, one entering at noon, one entering maybe after the first hour, and then go from there. So now I've got some homework to do myself.
Yeah, and I'll just point out that, if you were doing this in a back test that took 2 seconds to run, You
Mm.
would have never thought this would never have dawned on me. Like I would
Yeah,
never
you
have
just would have done it.
never even thought about it. Like why would
Yeah.
you? This is, as we've said in a couple of episodes ago, I think a really quick back tester kind of creates some bad habits. And having a longer back tester, a little bit Pollyanna, a little bit, silver lining, glass half
Hmm.
full mindset of me. But it makes you think about, okay, what's really the best way to do this? Like, there's probably a better way. And the
Mm.
fact that a back test takes way longer in Amber Broker kind of creates this situation where, okay, well, I'm going to try to think about a way to get all my answers with just one back test.
Yeah, and for the way I look at it now, and just so I've explained my setup. I've got a Mac that I do everything on. I've got a PC that's locked away in the other room because I hate Windows that much, and it just runs back tests all day. That's the only thing I use it for is for real tests and for Amni Broker. So that kind of stuff actually works perfectly, where I can run one monster back test that has all these exit times and everything, and then I copy and paste the data into Excel on the Mac, and then I just set it to do something else. And it's okay that that thing's working its butt off for however long, because now I've got more time, more data in my hand that I can do to keep myself occupied while the computer goes and does something else. And I think that's a good thing to look for and optimize as well, is that if I'm running the thing and then I'm just sitting there not doing anything for a long period of time, well, that sucks. But if I'm doing something like this where I'm getting all this column data and I'm getting all the exit time data now and all of this, then I've got a whole bunch of work to do. And it won't be as painful because I'm just not just sitting watching this thing kind of tick up and say, hurry up and finish. Instead, I've got other work that I can do to move that along. But yeah, that was a good one. I never thought of that one.
Yeah. I you know, I provide a column library with MapeKit, and
Hmm.
I love seeing traders use it because I know like almost every trader that I've ever worked with, I can see clearly before they do that they're taking probably 20% or 25% too many trades, and that one simple rule could improve their life dramatically. So it's really fun to see that when somebody goes through that I get an email from like, oh my gosh, I never would have known that this had the effect on the strategy. I love seeing that. It's
Well, and
awesome.
even more so, right? So let's say in this hypothetical universe, I'm currently testing and I'm optimizing the system for a close at the end of the day. Let's say I add this column and it turns out that a sell at noon or lunchtime does almost as well, even if it underperforms ever so slightly. Well, that's huge because now that's put me on my next path, which is okay, now I need something that is probably scanning for like unusual, outlandish moves that happen at lunch or into the end of the day. So not only, right, we're talking about, indicators that could filter out bad trades and things like that, but this kind of one tidbit may open up a whole bunch of buying power. That, right, if I exit this one strategy, if it's using up a lot of buying power and I exit it all at noon, well, now I've got the freedom and the room now for strategy two that I know is going to be completely different because it's going to trade during a period of time in which strategy one is kind of completely closed.
Yeah, I think that's great. I mean, you're exactly right. It doesn't have to be like you don't have to find something that's way better. You could find something that's almost as good. I love that.
Yeah,
So I was looking back at my results from the 2000 teens, and my best year during that period, I had a lower expectancy than the other years, but I had like 10 times the number of trades that than when I started. So it's not that, and I remember my mindset during that period was, okay, I just done automation, just implemented that. It's like, wow, okay, like I can actually relax my threshold for what a profitable strategy is because I can all of a sudden I can take as many trades as I want to. I did. I took literally 10 times the number of trades that I had just a couple years before. Each one of them wasn't great, but you add up enough of those trades and there's a whole lot of profit there.
so yeah, so I think you kind of guys saw in real time what we wanted to do, or the point we wanted to make in this podcast was that you need to have a plan to open yourself up to thinking about new columns or thinking about new ways to optimize existing strategies. Because again, as someone who's a prolific consumer of content, right, I picked up the MacDV by reading this paper, and then by sitting down with Dave, I picked up another one. So if you guys don't have that, I think that's the main takeaway. Is not, we gave you some good ones, I definitely think, but it's the process of how am I going to reach a little bit outside my bubble. We talk about it all the time, especially when things are going well. Traders kind of silo themselves and they keep doing the same thing that's working because it feels, when things are going well, it feels like magic, right? I woke up in the morning, I turned on the robot, and I made $1,000. It feels like magic. But you have to have that process to opening yourself up to what's the new thing, because you never know if there is something out there. So now I've got two things. I've got the MACD, and then I need to go and add these time columns in as well, and a whole bunch more work to do. So hopefully, the bot continues to tick on like magic for a little bit longer, and then I'm not working from an area of detriment. I'm working from an area of strength, where now I'm going, okay, well, now let's go and explore these new things while this guy over here just makes me some money, and then I'll come back to him and hopefully it makes more money.
Yeah, I mean, it's really what you're really doing is just becoming more efficient. And when you do that, you increase your ceiling dramatically. I mean, that's what you're doing as you figure out how to make a strategy more efficient, how to use automation to take advantage of it. Do what you said, which was brilliant. Can I exit these at noon and create a whole new window of potential for a strategy that's profitable? I mean, that's what you can tell. I love this stuff. I mean, this is so much fun for me to solve this, and I just love trading and everything about it.
Well, good. Well, I'm glad you do a podcast, but it would be really weird if you did a podcast about trading. You just hated every part of it.
Yeah,
But yeah, so we gave you some stuff. I think we gave you a process or a way to think about how to add more columns. Observe the market, consume content. There's a lot of good stuff out there, a lot of crap, but I'm sure people who probably stumbled upon this process or this podcast are probably decent at sniffing that out anyway, hopefully. And yeah, just make sure you're always open. You're always open to kind of figuring out what's next.
yeah. I think that's an important part of being able to adapt is not thinking you found the answer. I mean, I see a lot of traders that get stuck in that when they,
Hmm.
like I said, the only thing harder than creating your first trading strategy is creating your second, because you get stuck and you think you figured it out, and you always need to be open to the fact that you might be wrong, or it might be, your strategy might fade. You might need to have a completely different idea. So that's the hard part.
But as always, I'm Michael Noss.
And I'm Dave May. Talk to you next week on Line Your Own Pockets.